Welcome back. We're here with another webcast, Cary Williams, of course, with Marshall McAllister. This one is going out just to clients. Marshall, I am looking forward to hearing what clients think about this. We have a big announcement today. We're going to talk about an asset allocation change within our models that we're going to be talking to clients about over the next many months as we do our reviews. And so today, I don't want to take too much time with back and forth, Marshall. I think I'll just share the slides and we can get right into it.
Let's go for it, Cary. Thanks for the intro.
All right. So the new roadmap, reallocating U.S. assets. We are going to talk today about some analysis we've been doing inside of North Road around U.S. allocations versus the world, and walk you through some representative slides of how we've thought about the process. And we're going to finish off with a change that we've decided to make. And as I said, this is a long-term change, so we're going to be talking about this over the next many months as we do our reviews. If at the end of this video you decide this is something you need to talk about sooner than later, please reach out to us. But we do feel this is a longer-term change. So this is not an immediate, hey, we have a big concern right now, this day, we got to make changes. We are thinking about the future. All right. So Marshall, I wanted to just start by touching on and letting people know what's happened in the last few months. So this slide that we're looking at right now looks at U.S. markets represented by the Russell 3000 in green, and world markets from May, beginning of May to end of August. And we can see that the U.S. markets have significantly outperformed international markets over the last few months. I think many folks may be surprised by that because beginning of the year and into April when the tariffs were announced, that was not the case. And so this increase in, and call it a bounce back even potentially after the fall after tariffs, has caused us to reevaluate where things are at now. Anything you want to add on that one, Marshall?
That's good, Cary.
Okay, so let's talk a little bit about what we've been evaluating around markets, and we'll start with valuations. We have to start from this place of what is the market right now. And in the academic literature, we talk about this idea of owning the market as the default where you start from. So many folks, when I share this slide, Marshall, at the end of 2024, December 31st, where we look at the weights of different countries as far as their stock markets as a percentage of the total market capitalization of the world, many folks are surprised to find out that the United States, oops, pardon me, let me go back there, that the United States is 65% of the value of all global markets.
Yeah, when I started my career, that number was in the 30s.
Wow.
And it's progressively getting higher and higher and higher, and it's just exploded with some of the very successful, really large companies taking over just a massive amount of profitability in the world. I think it's important to note that 65% of the businesses have their head offices in the United States, but it doesn't mean that all the profits are coming from American consumers. These are, for example, Microsoft selling software to customers all around the world. It just so happens to be that business is situated in the United States.
Right. And a big part of this movement from, as you said, 30%, let's say, to 65% as the U.S. Percentage of the world, a big part of that has been that those companies have just done so phenomenally well, especially over the last 15 or so years since the 2008-2009 crisis.
Yeah,
so
exactly.
Let's take a moment, Marshall, and let's look at that, because that's a good transition into this next slide. This slide looks at S&P 500, so large U.S. Companies against the world, 2010 to 2024, and what has made up the outperformance, and sort of three factors that this organization, GMO, has broken that down into. So fundamental return, think of that as an example, profitability and earnings. Valuation expansion, so have the prices that investors are willing to pay, have those increased, and then U.S. dollar strength. And our clients who go to the U.S. know this. It's been challenging to have the Canadian dollar where it's at for a number of years.
Yeah, absolutely. So on the valuation, I think this might need a quick explanation. When we buy a stock, we are in fact purchasing the future profits, the stream of profits that business is going to generate. And the higher the multiple that individual investors are willing to pay for that future profit stream would kind of tie into this valuation expansion. And in the United States in particular, growth stocks exactly show much higher multiples than we've seen historically to be a normal valuation.
All right, so let's go through each of these. We're talking about valuations first. And on that note from you, I've got this chart. There's lots of lines here. So let me just point to a few things. USA in black, everybody else below that. And you can see if USA is the black valuations versus other areas of the world, there's this significant gap in valuations between the US and everywhere else. And there's a reason for this. US companies have done a phenomenal job over the last, call it decade plus, in growing their businesses. And even though we saw a real downturn in 2022, that has now bounced back over the last few years to back to levels where we were in 2021 or at least close.
Yeah, that's right.
So Marshall, one of the things that's a little counterintuitive about this is that valuations go up because investors are rewarding companies for doing a good job. But what does that mean for future returns for those companies that have high valuations?
It means the expected return for the new owner of the business is going to go down. If you're paying more for a particular stream of earnings, that then connects to a lower expected return in the future. Everything is connected to risk and reward in equity markets and in private markets, and paying more for a business will drive down your expected return.
That's right. So if we go back to this slide that looked at these three areas of outperformance, or that three areas that contributed to outperformance, for the US to continue to outperform again for the next decade, the way it did over the last decade, we have to see fundamental return. Okay, so maybe they're more profitable than other companies, and valuation expansion over and above where it's already at, and US dollar strength over and above where it's already at. And so in our minds, we're saying, okay, what's the likelihood, what's the probability that the US continues to kill it and surprise again for the next decade? That seems like a very challenging bar to jump over.
Yeah, I agree.
Okay. All right. US dollar diversification. Let's move on to talking about this US dollar strength and what that means. So, Marshall, years ago, I can't remember how many years now, you and I wrote an article about why it's valuable for Canadian investors to hold US assets in US dollars. And one of the reasons was that in a crisis like an 08, 2009 crisis, there's a flight to safety. So, especially US dollars. Many investors want to go and buy US dollars when they're concerned and have concerns about things, and that actually is an additive diversifier, or in most instances an additive diversifier to Canadian portfolios.
That's great. If we would have hedged our US dollar exposure to Canadian dollars with our or let's just call it our US equity holdings or US fixed income holdings, we don't get that protection in our portfolio. And we saw it, like it was substantial. Owning US assets in that crisis experience helped our portfolios lose less money. Really, really valuable.
Right. So one of the things that we have been watching, and that has been a surprise and a bit of a concern on our end, at least as a data point, so not predictive of the future, but of something we're noticing, is that in the most recent crisis around tariffs, in this chart on the far right, February 2025 to June 2025, we actually saw the S&P 500, which is the line in yellow, go down. And instead of the US dollar going up, instead of that flight to safety for US dollars, the US dollar went down as well. And then when the S&P 500 bounced back, the US dollar didn't bounce back with it. So this is something that is different, as we can see from the other lines. It's something that's very different from other moments of downturn in the S&P 500. So this chart shows in yellow where the moments in the last few years where the S&P 500 fell by more than 15%, and what happened in the US dollar. And then we've got this very unique situation around tariffs in April.
That's right. So this could be, a random event that isn't going to describe the future, but it also could be an indication of a new look at what U.S. dollars. We don't know. Let's just be clear, right? We can't tell you which one it is. All we can point to is the break in the pattern.
That's right. And Marshall, in our last video, our mid-year review, I showed this chart that showed that U.S. dollar trends are very long-standing. So when they do turn, they do last for a long time. And so perhaps this is the moment when we see a change. We have no idea, but it does give us pause as to whether or not this is going to continue to be an effective crisis diversifier, as we sort of assumed in the past.
Yeah.
All right. Let's talk about capital market assumptions. So, Marshall, capital market assumptions as a definition, I'll say for folks who are watching, this is the idea that investment firms try to put some sort of a prediction, an assumption to what capital markets will provide for returns. So, capital markets being stock markets, being bond markets, maybe the US market or maybe Europe or those types of things. And so many firms put these capital market assumptions together to give an idea as to what are they assuming when they look at where should they weight their allocations, as well as for financial planning.
Absolutely. And we at North Road take a consolidated view of all of these professional firms, primarily in North America, and we want to take that consensus to make our expectations on what expected returns are going to be in Canadian markets, U.S. markets, fixed income markets, all the markets that we're participating in for our clients.
Yeah. So we put together this slide just as a snapshot, as an indicator of some of the things we're looking at. And we looked at where are there's about 18 organizations here, large and small, but very well known. And where are they making estimates around non-U.S. equities and U.S. equities? And so we know, and we're very open with clients, that the future cannot be predicted. It will surprise us, right? And so we don't believe that these are gospel, for lack of a better way to put it, but these are just indicators that we can use as pieces of information along with the others to develop this matrix of information that helps us to make decisions. A couple things I wanted to highlight on this, Marshall. So on the right side, international equities, we're sort of seeing the majority consensus in this range somewhere, let's call it between 5 and 8, maybe 5.5 and 8.5. On the US side, the consensus is much more, I'll call it sort of diverse in a way. It tends to be a little lower, but we've got quite a lot of outliers. There is this question mark for many firms as to what's going to happen in their assumptions with the US equity piece.
You notice that there's no 15% compound returns for the US market. No one's expecting that. And that's what we've seen, right? It's like the returns have been out of this world. And we're not looking at any firm that's predicting similar returns into future periods. But we are seeing firms that are throwing numbers in the 4% range. That's different than what I would normally see in years past.
Yeah. Okay. All right, Marshall. So the next stage in our analysis, we did more than this. I thought these slides were good indicators of the things we've been talking about. But the next stage in our analysis is always, okay, what if we're wrong? Right? Like our number one goal is to ensure that clients are diversified and taken care of, and that nobody experiences concentration risk in a way that really is painful in the future, right? So we always do this analysis of what if we're wrong. Okay.
Yeah, let me jump in on this one, Cary. We've been wrong for 10 years already. So let me tell you about what we've been wrong on. We've been telling clients that international diversification has been the right move. And if we get more complicated, we've been talking about owning businesses with lower multiples and lower capitalization numbers. It would have been better for us just to own businesses in the United States and own the biggest ones possible over the last 10 years. And that's been the same for when we've been running North Road as well. We didn't do that. Professionally speaking, it was still the right thing to recommend. But now we can look back and say, well, what would have worked out better for returns? So now going forward, it's September 2025. We have a decision to make with regards to how we are going to recommend diversification. And to be clear, diversification is still going to drive the majority of the weight of the decision that we're going to be making. And to that end, we do not abandon U.S. equities in our portfolio, but we will be making a shift in the overall exposures. So let's talk a little bit about historical observations of people making predictions, and I'll turn it over to you to this one, Cary.
Yeah, that sounds good. So this is a snapshot, again, just an indicator of data that allows us to represent some of the thoughts we're having. But this is looking at 10 different capital market assumptions, 10 different firms for 10-year assumptions, the assumptions that they made in 2014, and then what did it look like 10 years later. And you can see on the US side, over way on the left, the assumptions were in that tight band that I showed you earlier. And yet we got that massive outperformance for US equities. And on the international side, developed ex-US, emerging markets, same thing. We've got these tighter bands and then significant underperformance compared to where folks thought it was going to be. So we know the future is unpredictable. And as a result, when we say, what if we're wrong, we're using that to be a foundation for how do we make sure that we take care of folks over 10-year periods, even if we're making decisions that are different for the future. And so if we're going to, as an example, what we're going to show you next, reduce some of our allocation to the US, we want to make sure we're doing that in a sensible way, recognizing that the future is unpredictable. So Marshall, let's just talk about next steps for clients. Do you have anything that you really want clients to be thinking about, or things that you want them to be reaching out to us about, anything like that that you want to recommend to wrap up?
Yeah, you know what? I think let's talk about the one thing that might drive conversations. This is not I don't like Donald Trump and this really makes me feel better.
Yeah.
This is not that. This is capitalism is bigger than Donald Trump. Global markets, sales, profitability, foreign exchange. It's bigger than him. Now he's definitely influential, but we are making a decision in connection to valuations and expected return. And if you want to call us up and riff about how frustrated you are as a Canadian looking at what's going on down south, we're happy to have the conversation. But this is not going to drive why we're making the portfolio change.
Yeah, I think it's important on the flip side too, Marshall, right? If you're really excited by what he's doing, we're happy to listen, but that has no impact on our decisions.
That's right. Yeah.
Right.
That is right.
And the same thing goes for Canada, right? Like no matter who's prime minister, we're not going to make an emotional decision about politics and how it affects portfolios. And that I think is really, really important that we continue to do that, that this is a conversation and an evaluation and decision making based on what we see in markets and around profitability of firms and around the globe.
Yeah, absolutely.
Okay. I'm happy to end it there, Marshall. Anything you want to finish on?
Have a great day, Cary. How about that?
Thanks, man. Same to you and everybody who's watching.
Awesome. All the best.
Thanks. Bye-bye.